Um, as I was just saying, I suppose by the end of the year, a set of legislative proposals are due to come before the Oireachtas on the Central Bank Commission on Banking. And of course, that's the new and fully integrated regulatory institution for the country. And I think it's fair to say that in all likelihood it will generate probably very limited public interest, and the analysis will be confined to the business sections of our newspapers. Similarly, just over 2 weeks ago, the European Commission published their own set of draft legislative measures proposing a new European supervisory structure and aimed, as Barroso dramatically put it, to inspire a global system of financial regulation. Understandably, I'm not sure that this captured much of the public imagination either. So, of course, it is the solution to the banking crisis, i.e. NAMA and the alternatives that are going to be discussed here later, rather than the foundations for a healthier banking system that dominates public debate at this point in time, and justifiably so. Yet it is the changes to the regulatory framework that we hope will have some major impact on the landscape of the Irish banking system in the years to come, and will in some ways address the critical failures that have contributed or have led to the breakdown of the regulatory system and the mess that the banking system is now in. And I'm reminded of the case of Sweden. Of course, the Swedish rescue plan for their own financial crisis in the 1990s has been much discussed and has been held up as a very similar model. But indeed, their own Auditor General and other persons who were very involved with the reform of the Swedish regulatory model at the time in the 1990s have since conceded that they haven't got everything right either. Certainly, with all the reforms that were brought about, they weren't able to mitigate or accommodate, prepare for all the issues that were going to happen further down the future. So I think that's a very important lesson that we might take from that. That certain, I suppose, to understand the huge importance of the regulatory reform project that has to happen. So, notwithstanding the fact that so many questions surround NAMA, or so many questions remain unanswered surrounding NAMA, I think it's also of crucial importance that some sort of debate commences about the new regulatory framework in this country before the legislation is published and effectively rushed through. Now, I'm sure as many of you might be, well, some of you might have been aware, SIPTU, and I was just saying there, I work for SIPTU, but we've had our annual conference just in the past week, and as you might imagine, NAMA was a hot topic of debate. So I propose today to not talk any more about NAMA at all, but to, as I was just saying there, talk about the regulatory the regulatory reform project. I'm sure it'll probably get plenty of discussion time in the questions and answers afterwards. But what I want to do instead is just look at three things. Briefly look at the principal contributory factors that led to the breakdown of the regulatory system here. Secondly, just assess the impact, if any, of the European Commission's proposals on Ireland's regulatory framework, and conclude with some thoughts on the role of the banks in the market economy. So, although there have been plenty of explanations about the boom and bust in the wider economy in this country, the problems that pertain to the regulatory system here and what contributed to the letdown, to my own mind, appear to be less well documented, or certainly have been less well commented upon when you contrast that to the UK. And of course there have been some very notable exceptions, in particular the incoming governor of the central bank and a few others. But certainly when we look back at the past mistakes, I think there's three main failures that we can identify. And it's important to identify them, so obviously we know how to correct those mistakes into the future. And the first is the ethos of how regulation was conducted. The second is the failure of the model that shaped the regulatory rules. And the third is the failure of the regulatory metrics. And none of this will be new to you, but I think it's important that we just kind of think about it in that sort of a way. Firstly, with regards to the failure of the ethos of regulation, as we're all aware, the regulatory framework up until now was very much based on the so-called light touch of regulation and was principles-led rather than rules-based. And this style of regulation was, of course, non-interventionist in nature. And looking back now, it's remarkable that despite the radical departure in banking policy in the main Irish banks in terms of their loan-to-values, you must remember in 2006, 2/3 of the loans that were lent out in 2006 had loan-to-values in excess of 90%, and 1/3 of those loans had loans-to-value of 100% in 2006. And I suppose it's remarkable looking back now, the very meek response from the regulator at that particular time. Similarly, the regulator appeared to turn a blind eye to the impact of the performance-related culture, which was ingrained in the banking system, and that such a pace of expansion year on year in the balance sheets of the Irish banks did not prompt some comment is again, quite remarkable. And in fact, I was just looking back this morning, Maurice O'Connell, then Governor in 1997, noted in a statement to an Oireachtas committee that the central bank had no such authority to restrict the supply of credit at that time, and I suppose in subsequent years it could be said as well, and if it did, it would be unworkable as demand would be met from overseas. And I suppose if there was ever a prophetic statement ever made in advance of the boom times for the banks, that was certainly it. The second failure is the failure of the model of regulation, and I suppose this is the model that was based on the premise of protecting the viability and shareholder value of individual banks through a series of capital and liquidity requirements, but which had little or no reference to the collective responsibility of banks to maintain the health of the overall banking system. In other words, commercial activities that were individually rational from an individual bank's perspective were inefficient at the market level. And we need look no further than to the impact of increased competition on banking margins as a very clear example of that, particularly after the emergence of the Bank of Scotland Ireland and Halifax into the property development and the residential mortgage market respectively after the turn of the decade. Increased competition had the effect of driving down the cost of borrowing, which of course was great news for the consumer, but which raised serious issues with regard to the sustainability of the individual banks. So what are we left with now? As we're all only too aware, we're left with a situation where the banks no longer have recourse to cheap borrowing on the interbank wholesale markets to fund their overextended loan-to-deposit ratios. The banks have cut back on their lending, of course, which has had a major impact on the economy, and they will, and Perna and TSB, I think, are, well, that I can recall anyway, the only bank to date that have said that they are going to increase their the rate of interest charged in existing loans in order to pump up their margins, so to help pay for the attractive interest rates that they've now put in place on deposits to obviously try and attract depositors in. So in effect, we've ended up with a market failure. It has now emerged in the undersupply of loans to both households and to non-financial corporations, due in part to the excesses of competition in the past. And the third is the failure of the metrics of regulation. And arguably there was an over-focus by regulators on risk measurement to the detriment of a more comprehensive form of supervision in the form of risk management over the last number of years. And it's interesting that the focus on the pro-cyclicality of the regulatory minima has become the subject of much debate across both the fiscal and the financial sphere within the EU over the past 12 months, just as the problems inherent in the design of the Stability and Growth Pact have now come home to roost, so too have the issues relating to the capital adequacy ratios. And although they were necessary, they were far from a sufficient condition to ensure the sustainability of the banks. It's also interesting to note, I suppose, when the Turner report was published in the UK earlier this year, it spent much time discussing these issues and has suggested that instead of imposing minimum capital levels, that perhaps a move could perhaps be made towards a system of maximum permissible leverage ratios. So that's something certainly I think that our own regulatory framework has to consider in this country. I suppose the other aspect of this is Spain is the other Eurozone country that has seen an even greater collapse in the building and property market relative to Ireland, and yet their banking system has got off certainly a lot easier. It has held up relatively well compared to Ireland, and of course that was due in part to the activist mode of banking regulation in place there. And a regulatory framework called dynamic provisioning was introduced by the Bank of Spain in 2000, and this provided for a charge against income to be made on a regular basis to provide for losses that had not yet materialised but were likely to happen during downswings. And certainly I think that aspect was missing in this country in terms of how they approach the metrics. Of course, this was complemented as well by significant numbers of regulatory staff actually working from within the banking institutions, and of course that's very different to how things panned out here. So the question remains, if the Irish regulatory system has failed in all these aspects, what impact will the Commission proposals have on the Irish regulatory landscape here? And there are two proposals from the Commission for the establishment of two main bodies: the European System of Financial Supervisors, which in the context of the existing regulatory structures for banking at a European level, is just a small step up from the Committee of European Banking Supervisors that has been in existence now for a good number of years. And the second pillar is the European Systemic Risk Board, which is a new macro-prudential body set up to assess the risk to the stability of the entire financial system. So you might ask, what difference will there be for Ireland from both of these bodies compared to what it went on before? And it seems to me, I think the main difference is that the European Systemic Board, while it can still only issue non-binding recommendations, which is similar to before, the institution or the central bank to whom the recommendation has been addressed or issued to will be compelled to explain its inaction if it fails to comply. And in some ways that's how the European Systemic Risk Board is getting around its lack of legal status, I suppose, within the treaties of the European Union. Credit rating agencies are the only institutions to be directly supervised at European level at this point in time. But it is interesting that the Commission notes that the changes highlighted above will act as building blocks towards greater regulatory coordination. And I suppose debate has yet to happen in this country as to the desirability of that. The European System of Financial Regulators is also, this is the other body, is also charged with the harmonising of technical standards and ultimately the development of a common rule book. However, this pertains more to the methodology rather than the policy decisions associated with minimum regulatory levels. And of course this is something that's not new to Ireland, given that we've been dealing with Eurostat technical standards for a long number of years now. So just to conclude, I suppose this all brings me to kind of speculate on the nature and the shape of the Irish regulatory framework in advance of the publication of the legislation. And I suppose it's been very interesting over the past 24 months. You know, we've been very much assured that, you know, that some banks were deemed too big to fail and too important to the Irish economy to collapse. And in some ways this vividly demonstrates the semi-public good nature of banking activity in any market economy. And if indeed banks are the nervous system of a market economy, and if an implicit assumption exists that the state will ultimately come to the aid of a distressed bank, then some thinking needs to be done as to what exactly the implicit guarantee should cover. And of course there's already been a lot of debate as to what the guarantee that was introduced September 12 months ago did cover and what it maybe shouldn't have covered. But I suppose ultimately our debate needs to be framed in the context: should it be there to ensure the continuity of vital banking services, or should it be there to ensure the corporate survival of the larger banking entity? And ultimately this brings me to the major question as to whether banks should be regulated as commercial enterprises or as public service utilities. We need no reminding that banks are not normal commercial enterprises, and indeed, you know, it's amazing how things have moved on now. But when I think back to Waterford Crystal in early 2008, they were looking for a loan guarantee of just 37 million from the government at the time. And of course that's just, you know, that's pocket money now relative to the sums that we're now talking about with regards to NAMA and of course the state guarantee. We're told the major regulatory challenges now facing the central bank and the government relate to getting the balance right between, on one hand, the facilitating of a profit-generating banking system that can contribute to sustainable economic growth, and on the other, the limiting of the moral hazard that has, you know, comes part and parcel of a system that knows it can ultimately rely on the guarantee of a state for its ultimate survival. If regulation goes from one extreme to another, we are in danger, as Patrick Honan has put it many times, of pushing, replacing the risk aversion that now exists within the banks with state-imposed curbs to lending. So, you know, obviously neither extreme is desirable. But I think there's a bigger and a deeper debate to be had here. The capacity of any one business to make a profit and thus survive, or become insolvent and hence dissolve, goes to the heart of what a market economy, capitalist market economy ultimately is. It is clear that banks do not fit this description. So I think this is where debate now needs to move to. We now need to consider how we can advance and protect the interests of the state, the interests of taxpayers, and ensure the continuity of banking activities in the new regulatory framework. Thanks.
Meeting the needs of older people, and that will probably take this year. Okay, thank you. So we've had